Hi everyone, welcome to Bond Bytes, a daily bond market highlights from INR Bonds. I'm Arjun Patsakti, and in today's bond market, government bond yields were flat while the equity Sensex and Nifty rose. The rupee fell marginally. Markets are just now shifting positions here and there. While in the corporate bond space, ICICI Bank raises rupees 3,500 crores or 35 billion to infrastructure bonds, 7-year maturity bond at 6.67%. And the interest rates are pretty low for this issue, given that it's the spread to government bond yields is just around 0.45%, so 45 to 47 basis points, which is pretty good for the infrastructure bonds. And as India, as banks raise more infrastructure bonds, a lot more lending can happen to the infrastructure sector. But most importantly, in today's topic, we will explain India in global bond indices. So the news is that India is planning tax changes to make sure that its bonds are included in global bond indices. Now, what are global bond indices? Global bond indices are indices created by organizations like Morgan and Stanley and others. And these indices, like similar to if you look at inequities, you have the S&P 500 or the Sensex and Nifty in the equity indices and other indices. These indices have a bunch of bonds, global sovereign bonds, as in different countries. So this would include bonds of, say, many other emerging countries, including China, Brazil, and other big countries, Russia, and other countries. And then foreign investors, global investors, pension funds, insurance companies, and other very large investors, and also other funds, mutual funds. They invest in these bonds based on their weights in these indices. So when India gets included in one of these indices, then automatically many funds that are investing in bonds that comprises of the indices will have to invest in Indian bonds. So this, in one sense, it's highly positive for India because a lot more bond flows will happen from foreign investors. But having said that, then India's again one more positive is that because India is now in the global bond indices, then the country has to manage its macros very well, because any kind of discrepancy or worries on India's on the macroeconomic front, which is fiscal deficit, inflation, could impact the currency and could also impact the fact that many investors who having invested in the bonds may not like to see too much of depreciation in their capital because of large fall in currency and rise in interest rates in India. And they might even pull out, and that could impact India's position in the indices itself in terms of weight and other things. So a lot of issues, a lot of macros India has to manage, which is positive, and accountability also rises to foreign investors. On the negative side, the volatility of capital flows is always there, and excessive capital flows into the country through bond flows can impact inflation and liquidity and other factors. But yes, I mean, it also, if your positives outweigh negatives, then India stands to benefit from being included in the global bond indices. That's about it for today's bond bytes. Do not forget to check out our Quick Invest retail digital bond platform, where you can see a curated list of bonds, which gives you the best bonds to invest in the market at this point of time, based on your preference. And you can see all the information, including proprietary information, and transact in a transparent and highly seamless manner for you to invest in bonds through our electronic platform. The link to Quick Invest is given in the description below. And if you are not subscribed to our YouTube channel, please do so. Thank you very much for listening in.